Good morning, everyone. Thank you so much for joining us today. Happy Tuesday. Today is our next in a series called Secrets of Successful Retirement webinars. Today, we're going to be discussing taxes and how the taxes are rising and ways to plan to avoid those rises or overcome how we can save on taxes. Okay, so at Senior Resource Center, if you want to know a little bit about us, we do 4 specific things. First is we do comprehensive retirement planning. So that's looking at your overall retirement plan, your assets, and making sure that we can help you to know that you're not going to outlive your money. The second is tax planning, which is what we're going to talk about today. We don't do tax prep, but we find ways to help people pay less tax. And the third is long-term care planning. We help people to qualify and protect their assets to get federal and state programs, as well as look into insurance products to help protect their assets from long-term care spend down. And last is estate planning. We're not attorneys, but we do help people to look at their overall estate and make sure they have the right plans in place and legal documents so that they can pass on their assets to their heirs or protect themselves while they're living. Okay, so if you missed any of our previous webinars, the ones above the highlighted taxes rising, you can always go back to our website at srctexas.com, go under resources, and there's all the webinar recordings, not just from this series in 2022, but also last year's series, 2021. And just click on the words, and that link will take you to a video so you can watch them at any time or pass them on to friends and family. Next week, we are looking at critical legal documents. And then in the coming weeks, we have webinars on income, what about people under 60, how to avoid probate, looking at Social Security disability, about modern annuities and how they've changed over time, and then Plan B. So stay tuned for those. And so next, I'm going to introduce my business partner and the author of Secrets of a Successful Retirement, Bill Witt.
Tara, well, first tell our listeners how to post questions if they have
interest. Yes, of course. So there's a talk bubble at the top of your screen. If at any time during the webinar you have a question, just go ahead and type it in there. And then at the end, we'll address all those questions. And don't feel like you're disrupting us if you type in those questions, because you're not. But we want to make sure if any questions are thought of that we're able to get to them during this webinar. All right, take it away.
Well, thanks, Tara. Welcome, everybody. We're talking about probably one of our most people's least favorite topics. We live in a divided country where you got Republicans and Democrats, and we're polarized, and we can't agree on a lot of things. But I think if I did a poll today and asked who would like to pay more tax, pretty much most of us would give that a thumbs down. Paying taxes is part of living in a great country, but as we're going to see today, there are many ways we're being taxed. Some of them are highly visible, but many of them aren't visible. Many of them are hidden, and when you add them all up, there's a lot of tax. And I started by saying our country probably has the most complicated tax system in the world. The rules that govern the taxes are complex. They're constantly changing. So having a plan to pay less tax is important to a safe, secure retirement. And here's kind of the range of the problem. I've got listed on the left side of the screen all sorts of categories of taxes. Now, some of these are pretty obvious. We all pay income tax, and when we are working, we contribute to Social Security by having funds withdrawn for Social Security tax. There's a Medicare tax. There's a Medicare surcharge. If you make above certain limits, they dink you with surcharges. We pay property tax, sales tax, capital gains tax. If you buy a vehicle, you pay a vehicle tax. When you pump gasoline into your car, there's gasoline tax. There's excise taxes, privilege taxes. Businesses, some in Texas, pay a franchise tax. And then when we go to meet the Grim Reaper, we have to pay, some people pay an estate tax. All these are in flux and constantly changing. And, you know, most of us think, well, I pay income tax. But when you start adding up all of the other taxes that we are subject to, Uncle Sam or state government or local cities or local property taxing authorities are taking a piece of everything we own. And this applies to what we earn, what we save, how we invest, and then just the privilege of having certain items causes us to pay tax. So add it all up, there's a lot of taxes. And as Tara said, our practice is focused on tax planning. We help people investigate different options. So a simple rule of thumb, understand all the taxes you're being exposed to, make informed choices to reduce your tax obligation, because every dollar we don't have to pay in tax is a dollar that you get to save or spend on something else. So what are we going to talk about today? I've got to cover a lot of ground in a very short period of time. And today's webinar is more educational. It's, hey, there are ways in each of these categories to pay less tax. Our goal is not to give you all the rules, but to tell you that there are ways to pay less tax. And if you have further questions, obviously give us a call. Our consultations are always free. Our goal is to help our clients make informed decisions. So today we're going to talk about ways to pay less income tax. I'm going to talk about that Medicare surcharge, the IRMAA surcharge that many people are exposed to. I'm going to show you a way to pay less tax on retirement accounts. In fact, let me go a step further. I'm going to show you how to get money tax-free out of your IRA. If you've ever wondered about that, usually when you take money out, you have to pay taxes. I'm going to show you how to take money out tax-free. We'll talk about capital gains tax, ways to pay less property tax. Finally, I'll talk about some charitable opportunities for people that have a charitable bent, and then we'll take your questions. So let's talk about income tax first. Most people know that we have kind of a graduated tax system in our country. If you're single or if you're married, you pay different rates of tax based on different parts of your income. So let's take the 10% bracket. For single people, the first $10,275 that's eligible, that's income, you're going to pay at a 10% tax rate. For marrieds, it's $20,550. If you make more than these numbers, let's say you make $41,000 as a single person, well, a portion of your income that's subject to tax, some is taxed at 10%. The amount above $10,000 is taxed at 12%. This is a progressive or a graduated system where the higher our income, chunks of our income are exposed to a higher tax rate. Well, now that we know the structure or where the taxes are, how can we take advantage of the tax system and make some smart decisions? And if you go back a couple of years ago, President Trump signed some legislation that dramatically increased the standard deduction. Most people, when they file their return, they either claim a standard deduction or they may itemize. But because the Trump tax bill increased the standard deduction, more and more people are now using this instead of having to itemize and gather data on mortgage interest and other things that can be itemized. So let's say the standard deduction this year, it's $12,950 for a single person, $25,900 for a married couple. But if you're 65 plus and single, you get an additional $1,750 added to that $12,950. If you're married and both of you are 65 or older, you get add on an additional $2,800. So how do we take advantage of this? Well, going back to the top of the chart, what's the ceiling on the 12% tax bracket? $41,775 for a single person, $83,550 for married filing jointly. And if we add that number, and let's say we're a married couple, we're over 65, both of us. So I add the 25,900 standard deduction, the additional 2,800, and I add that to the 12% tax bracket. Well, that gives me a total of, if I'm married, 112,250. And what that says is, if I'm reporting 112,250 of gross income, all of my income's either being taxed at the low 10 or 12% tax rate. If I'm single, the ceiling is 56,475. Now, why is this important? Because we're either over or under these numbers, right? So let's see if we can take advantage and see if we can explore some opportunities with the tax code. Once again, this is all legal. We all have to pay the appropriate tax amount, but with tax planning, sometimes you can pay less. So Tara and I say, what's your optimal gross income? It's those two numbers, the 56,000 or the 112. Are you above or below that optimal gross income? If you're above it, you're going to be in the 22% bracket. If you're below it, your income is all being taxed at 12%. So if you're below your optimal gross income, this is a unique opportunity to convert IRA dollars into Roth IRA dollars, which offer future tax-free growth. So let's say I'm married and my gross income is below 112. Let's say it's 100,000. Well, I have $12,000 of opportunity there where I could be starting to convert IRA dollars to Roth dollars. If I'm older than 72, we'll be talking about this in a minute, I have to take required minimum distributions. But even there, if the total, I'm still below that 112 threshold if I'm married, I could be converting extra IRA dollars to Roth dollars. Why might I want to do that? Well, Roth IRAs, whatever they grow into is tax-free. You don't pay any tax on whatever a Roth IRA earns in the future. And second, there's no required distributions from a Roth. So oftentimes people convert IRA dollars to Roth and they can let the money compound, grow, and then pass it on to their kids or their spouse tax-free. So if I'm below the optimal gross income, this is an opportunity for IRA to Roth conversion. What if I'm above the optimal gross income? Well, there are some forms of income that you and I can control, and there's others we can't. Let's say I'm getting Social Security. Maybe I've got some annuity income, pension income. My wife's a retired teacher. She has TRS payments. And let's say I also have some 1099 income. I'm receiving 1099s because I have money in a brokerage account or maybe in a CD. Well, we can investigate. In that case, I have two types of income, some that I can't affect. I'm going to get my Social Security check, like it or not. I'm going to get pension checks or annuity payments, like it or not. But maybe some of my income that's putting me above that optimal gross income is 1099 income. Let's say I have a CD. I know they're not paying much, but you put 300,000-400,000 in a CD, you're going to get a 1099. Well, we can investigate tax deferred options. And if you've listened to our other webinars and if you've read my book, you know that Tara and I use different kinds of products as tools to build safe support retirement plans. One of the tools we use are annuities. These are insurance-based products. And one of the advantages of an annuity is, like your IRA, it grows tax deferred. Unlike your IRA, when you turn 72, you're not forced to take money out of your annuity. But with an IRA, we do have to start taking required minimum distributions. So let's say the income that's putting me over the optimal gross income, forcing me into that 22% tax bracket, is CD interest. Well, just by rolling it over from a CD to a tax-deferred annuity, a couple of things happen. One, I'm probably going to get better growth because annuities always or usually pay more than what a CD is offering. Annuities also offer credit lawsuit protection. We have a client we're working with right now that has substantial amount of money in the bank after selling some property, which is wonderful. The problem is it's not keeping up with inflation, and maybe more worrisome, this family, the member that owns it, still drives a car. What if he or she has an accident and injures somebody or kills somebody? You know, we watch these ads on TV about call Thomas J. Henry or call whatever his name, who says, I'm on top of it. Uh, that money can walk out of the bank. Annuities are shielded from creditors and lawsuits, but more importantly, in this discussion, they shield the earnings from tax, which means maybe I just now pulled my interest income down below the 112 range, and I'm letting my money sit there, defer taxes, compound and grow, which is always nice. It's nice to have money compound and growing. And you get to decide when you pay taxes. So when we do income tax planning, we always look at what is your optimal gross income? Are you above or below the number? Let's take advantage of it because we know tax rates are going up in the future. How do I know that? Because the Trump tax rates expire in 2025. They're going to revert back to prior tax rates, and Congress may well up the taxes even before then because our government's still running massive deficits. Let's talk about another type of tax that's kind of sneaky. If you turn 65 in this country, one of the advantages to turning 65, most of us are eligible for Medicare coverage. And in our practice, we help people make informed Medicare decisions. You only need one stay in a hospital or one surgery, and boy, you can be out a lot of money if you don't have the right Medicare coverage. But Medicare is set up where higher income people get hit with surcharges, with higher payments, and we're always looking for ways to avoid these. So if you have Medicare, parts of it are subject to this IRMAA surcharge. This is a brochure we use to simplify Medicare choices. Left side, we have original Medicare, where at the bottom you have Part A and B from the government. A is your hospital coverage, B is doctor and lab. Above that, we show Medicare supplements or Medigap policies. These pay what A and B don't pay. So you pay a premium for the supplement, but then when you go in for major surgery, like I did a couple of months ago, I had eye surgery. I showed up, I showed them my cards. I have A and B from the government. I have a supplement. They said, Bill, take a seat. That's kind of nice. I didn't have to get my credit card out and pay a big amount. On top of the supplements, you have a fourth box, prescription drug coverage. So with original Medicare, you have two parts that are subject to the IRMAA surcharges. And that's Part D, the prescription drug coverage, and Medicare Part B, your doctor and lab coverage from the government. These are the two that are exposed to higher charges. On the right side of our screen, we've got Medicare Part C. If you listen to the ads on TV, we just ended the open enrollment period for 2022, and we were flooded with ads on Medicare Advantage plans. Tara and I are not real fond of these. They may have a fit for some folks, but they usually limit who you can go to as a provider. Many of them today are HMO plans, which means they have a closed network. You either have to be in network or you pay the full cost. Most of us don't want to pay the full cost. In addition, sometimes they have hidden costs. So we generally try to avoid Advantage plans. But Part D, Part C, and Part B from the government are all subject to the IRMAA surcharges. So what are these? Well, here's the chart for 2022. And this shows income ranges. If you're below 91,000 and an individual, or you have income of 182 or below, and you're a married couple, your standard premium for Medicare Part B is 170. That's what most people pay. But higher income people, let's say your income that you report is $1 over those ceilings. You report $91,001 as your modified adjusted gross income for 2020. By the way, what you notice here, they're not basing your 2022 Medicare B premium on your income this year. They're basing it on 2 years prior. Well, things might have changed. Maybe I retired. Maybe I cut back from full time to part time. Uh, Maybe I was married and my spouse died. Things change and people's income change. But the government's looking back 2 years and saddling us with higher premiums. If I'm single and I report $91,001 of income or $182,001 as a couple, both of us or all of us are paying that higher 238.10 premium. Unlike the tax tables, where if I'm a dollar over one of the thresholds, I might pay a higher rate on that $1. In this case, you report 182 and a dollar, both you and your spouse are going to pay 238, not 170. You can see the thresholds go up. So really, people that had higher income back in 2020, they can get stung with much higher premiums. Let's take a look at the Medicare D surcharge. As that this is for prescription drug coverage. I go out, I find a drug plan that I like. And by the way, Tara and I have a very simple way of showing you what your lowest cost drug plan is in Texas this year. How do we do that? We use a good website called Medicare.gov. Build a drug list, pick a pharmacy, and the website ranks all 26 plans in Texas by their annual cost. That's how we want to evaluate plans. What am I going to be out of pocket being on Plan X or Plan Y or Plan Z? Most of us want to pay less. Well, once again, there's income thresholds. If I'm above those different levels, if I'm 182 or below and married, or 91,000 and below and single, I don't pay a surcharge. I pay whatever the plan costs. But if I'm above there, I'm getting socked with a 1240 or a 3210 or a 5170 surcharge. And if you're married, this hits both of you. So, once again, we're trying to find ways to not pay the surcharges. So here's a simple solution on this one. IRMAA is based on your income 2 years prior. Many of us have a life-changing event. Maybe you had a marriage or a divorce, death of a spouse. Maybe it was work stoppage or work reduction, loss of income producing property, loss of a pension income, or maybe an employer settlement plan. All of these can affect what you earn today. And so we can go back to Social Security and say, hey, I know you think I was a big ticket guy back in 2020, but now I'm a smaller ticket guy. I make less. Well, there's a form called SSA 44 that you can fill out and report a life-changing event. Also, sometimes, tax records and tax filing get screwed up. Not too often, but if it does, and the IRS is saying, hey, you earned more than what you reported, and we're going to report this higher income. And you go, oh, whoa, wait a second. I didn't really earn that. And you want to clarify it. Well, you want to fill out form SSA 561U2. This allows you to report corrected tax information to the IRS, and then it will be funneled over to Social Security. Bottom line, just by filling out one of these two forms, we can tell Social Security, hey, what I made in 2020, not the same as today. Please reduce my IRMAA surcharges, and they will. Okay, let's talk about retirement accounts. We covered this briefly, or covered this a couple of weeks ago when we talked about ways to maximize retirement accounts. Most of us, as we enter into retirement, have two things. We got a house, we're proud of that, and boy, values have been going up, that's nice. We also have IRAs or retirement accounts, 401ks, 403bs. Those are the primary assets most people have. And retirement accounts impact what you and your heirs will have to pay in taxes. So earlier I mentioned required minimum distributions. Very simply, the government lets us defer taking money out of our retirement accounts until age 72. We turn age 72 and we have to start taking annual required minimum distributions. And it starts out with a percentage about 3.6%. IRS changed the table that they use for calculating RMDs this year. You go to the table, and for each age, 72, 73, 74, there's a number next to it, and that's the divisor. So how do you figure out what your taxes are going to be. Well, you take the rate, the amount in your IRA on January 1, you go to the table, and if you're 72, I think the divisor is 27.4. I divide that into the total in my IRA on January 1st, and that's the amount of my required minimum distribution. The amount of tax I pay is based on tax rates, and I said earlier, those rates are going to sunset in 2025 and are going up, which could also affect IRMA surcharges. So, what are our two options here? Well, I already mentioned one of them, gradual Roth conversions. You can do that before or after age 72 based on your optimal gross income. But there's the second one that's going to hit all of us, and it's what I call doing smarter RMDs, smarter required minimum distributions. And I'm going to show you a method Tara and I use every day for showing our clients how to not only do smarter RMDs, but also how to turn their IRA or 401k dollars into tax-free money. Here's a simple example. We got an IRA, same amount, both sides of the fence. Left side's an IRA, it's probably sitting in a brokerage account. Those are good when the market's going up. They don't feel quite as good when the market's in correction mode like it was in 2000 or 2008. Most of our clients coming in today go, Bill, I've already had enough haircuts. I'm into retirement. My money's got to be there. I don't want to go through another 40% correction. So I go, all right, well, let's see what we can do. So we divide the IRA into two chunks on the right side of the page. I show it as 50-50, but there's no magic to this. It could be 60-40, 70-30. You decide how much you want to put in each bucket. And the bucket we use is an IRA annuity. Well, let me tell you why we do this. What happens when we turn 72? Left side, we got to start taking money out. And the way most people take their RMDs is what I call annual dipping. They do the calculation, or their CPA does, and says, Bill, you got to take out $5,000 this year. Okay, so I take it out, wait till next year, and then do another dip. What do I do on the right side? Well, we add a feature to the IRA annuity. It's got a feature, it's called a lifetime income rider. Lifetime income rider. What is that? Well, essentially, we're creating a pension that's coming off the annuity. I still have my bucket of money sitting there. If I want to tap it, I could. But coming out is a lifetime income stream. If I'm married, I set this lifetime income stream up on joint life. What does that mean? It means, ladies, if you're listening, you're probably going to outlive us guys. And so the lifetime income payment, which is going to increase over time, is going to pay out whether the husband or the wife or both of you are alive. Well, let's fast forward. As I said, the percentage that you got to take out for RMDs goes up year by year as I get older. So you see that our annual dipping is starting to increase. And generally, the IRA is dropping in value. Likewise, the lifetime income rider is also increasing. It increases the rest of your life. You live to 102, the lifetime income stream continues to increase if the market's up. So what's happening? That IRA annuity is starting to lose value. It's paying out everything that's inside that bucket. The other part on the right side, the IRA that I'm not tapping is growing because what? I'm not taking any money out. Well, let's fast forward to the day when the IRA annuity goes to zero. What? It went to zero. But remember, it's a lifetime payout. So now, what am I getting? I'm getting free money. We show our clients how to get free money out of their IRAs. Live 12, 13, 14 years with an IRA annuity, and you too are getting free money. This is just like your Social Security check. You turn that check on, and what happens? After about 10 years, you've gotten back everything you paid into Social Security and everything that your employer put in. But the checks keep coming. Hey, that's nice. It's lifetime income. Well, the same is true with the IRA annuity. We've now drained the account, and it becomes a lifetime income stream that continues to increase until both of us are in heaven. This is what my wife and I have. We like it. But there's even one more step. I said, I want my income to become tax-free. I told you I was going to tell you how to convert IRA dollars into tax-free dollars. And here's the secret. Just before the IRA annuity goes empty, when there's only maybe $1,000 left in the bucket, what do? Well, we go back to the company and say, hey, 12 years ago, I set up that IRA annuity with you, very pleased with it, love the lifetime income stream. My bucket's almost empty now. There's only 1,000 left in it. I'd like to convert it to a Roth IRA. Well, because we've waited until the bucket is almost empty, instead of paying significant tax dollars to convert to a Roth when the bucket's full, now the bucket's almost empty. And I take advantage of a Roth conversion. And guess what? Now that tax-free income, not only is it free money, it's tax-free money. So you start this, you can start it before age 72, but 10, 12, 13 years after you start this, would you like to give yourself a raise in retirement? Most of my clients nod their head. Yeah, I think with inflation, I'm going to need more income. Well, what if we can turn that income stream into tax-free income so you don't have to share a chunk with Uncle Sam? That sounds pretty good. We show this strategy to all of our clients. It's legal. It works. If you have questions on this, please come see us. We'll show you how to do it. And here's an example. Tara mentioned we do 30-year retirement plans. We've got some super software that we use to tell our clients where they'll be 10, 20, 30 years into the future. Most of our clients say, Bill, I want to make sure I don't outlive my money. And so we build a model that's based on assets, income, and current expenses. We factor it for the tax rates in effect, and we also factor it for inflation. We're seeing a lot of inflation. That's got a lot of people kind of worried. If you're worried about that, go back to our very first webinar this year, the impact of inflation and why we think it's going to get a lot worse before it gets better. The Fed's moving very slowly. But here's an example. This is a case, real case. Lucy and Bill, both 68. Monthly income, or their monthly expenses, their budget in retirement is $6,000. And we projected it to grow at 2.5%. Once again, we can index individual components within the budget at different inflation rates. Medical expenses may be going up a little bit faster. Long-term care, that's going up a lot faster. Drug costs, you know the story. Now, Lucy and Bill have two forms of Social Security. Lucy's going to claim at 68. She's going to get $1,856. But Bill made the smart choice. He's the primary breadwinner. He waited till age 70. You want to know how to make smart Social Security choices, listen to the webinar we did on how to max your lifetime Social Security payout, or come see us. We'll show you how to do it. Bill and Lucy have $725 in savings. Most of that's sitting in 401k, and we project it to grow at 5% annually. We also know that Bill's not in the best of health, and his family average life expectancy is around early 80s. So we're going to project Bill to die at 83 and see what happens with their money. Long story short, and by the way, we created a second scenario. Scenarios one is just stay the course with money in the brokerage account. But I said, Bill, let me show you a different option. Let's take a portion of your 401k. In this case, it was $275. Put it in a 401k. And at age 70, it's going to start generating $1,107 of monthly income. That's nice. Even nicer, it continues to grow over Bill or Lucy's lifetime if the stock market's up. Well, I like that because it keeps up with inflation. So how do these two scenarios play out? Scenario one is on top. And if you run it and you can see the numbers, at age 100, Lucy, we assume Bill's in heaven, Lucy's sitting on $48,000 of money in retirement. But scenario two shows something very interesting. By creating additional guaranteed income in retirement, we've improved the couple's financial outcome. Tara and I have been helping clients create guaranteed income for years, and our models always reflect that people with more guaranteed income have better financial outcomes. If you don't believe me, read the book. My book, when I wrote it, I had to research, has anybody else recommended income? I found a study from the Principal Financial Group. They did it back in 2019. They hired two PhDs from the American College, said, hey, what does income mean to people in retirement? And they came back with two findings. People with more guaranteed income have better financial outcomes. I already knew that. The second half of the report was on the emotional impact of having more guaranteed income. They said people with more guaranteed income have more confidence. Confidence they can spend in retirement and not outlive their savings. Confidence they can leave money as a legacy to their kids. Well, what's the differential here? That 275 annuity expands or increases the amount that's going to pass on to the next generation, in this case, $241,000. How much would your kids like to inherit? We show you how to leave a bigger legacy. And most of us want to leave a legacy. We want our kids or grandkids to think about us, remember us for helping them with a financial start in life. If you have questions on how to get money out of a retirement account, come see us. Now, one last thing on retirement accounts. One of the acts that President Trump signed had some nice features in it. Well, it was called the Secure Act, and it let people delay taking required minimum distributions to age 70 and a half. It allowed part-time workers to contribute to 401ks. There were 4 or 5 wonderful things in Secure Act, but there was one that wasn't so wonderful. They had to pay for the act, so how did they do that? They eliminated lifetime stretch. What is that? Well, if I die today and I have an IRA and I leave it, say, to my son, under the old rules, my son had an option of saying, gee, I don't need Pop's money. I'm going to let it sit there. He too would have to take small required minimum distributions, but he could allow the majority of the money to sit there, compound, and grow, and he could take it out literally over his lifetime. Not so anymore. Now, all IRA funds paid out to a child, a beneficiary child, have to be taken out in 10 years. Well, why is this a problem? Well, let's say you die and your kids are in their mid, late 50s or early 60s. They may be in their peak earning years, already in a higher tax bracket. And on top of that, they're forced to take money out of your IRA. Guess who's smiling? Uncle Sam. Uncle Sam did this because Uncle Sam needs more money to run the government. We're spending more than we make, and Uncle Sam is trying to get money out sooner than later. So if you have questions on how to maximize your retirement account, how to get tax-free money, please give us a call. Another option that we explain to people, this is another option. We're not going to cover it today, but we will in the future. It's wealth replacement. Many people have IRA dollars. They're starting to take out money. What if you use some of those dollars to buy a life insurance policy? And I know what you're thinking. Hey, I don't need life insurance. I don't like life insurance. I don't either. But the proceeds from life insurance are all tax-free. Many of our younger clients, we're going to talk about this in the future, are using life insurance to plan ahead for retirement. Instead of putting all their money in a 401k, they're putting some of it into life insurance. Well, the money they put in, they overfund it, and that money compounds and grows. And then when they turn 62, 65, whatever, they start withdrawing funds on a loan basis. All the withdrawals are tax-free. That's pretty nice, having more tax-free in income in retirement. You're not tied to IRA rules where you're forced to take money out. You're not tied to Roth rules where you're limited in how much you can put in. A lot more flexibility. So if you want to know how to get more money out of your retirement accounts, come see us. We have multiple strategies. Let's talk about less capital gains tax. What is capital gains? If you buy something and you hold it for more than a year, you don't pay normal income tax on the gain. If I buy a share of stock and it goes up and I sell it 6 months later, whatever it earned or grew into, on the growth, I have to pay normal income tax. But if I hold that share of stock for more than a year, I pay capital gains tax either at the 0% rate, that's pretty sweet, or at 15 or 20%. And if I'm a higher income individual, those 15 or 20% rates can be very attractive. Compare that to some of the higher rates we saw where you're into the 30s, 30%. paying tax. So, what are my options on capital gains? Well, first, on most assets that grow, if you hold an asset to death, you get up what's known as a step up in basis. So I buy a share of IBM, I hold it 10 years, and I die. It's gone from $1,000 up to $10,000. That'd be nice. Well, my heirs don't pay any tax on it because I get a step up in basis at death. Now, President Biden's talking about tweaking this, taking this benefit away. What if I own a home? My home is wonderful. I love it. And boy, they've been appreciating. If I'm single and I sell my home and it's grown in value by 250,000, I don't pay any tax on that gain. Ooh, that's pretty sweet. What if I'm married? It's even better. My home's increased from 400,000 to 900,000, $500,000 gain. I don't pay any tax. That's really sweet. So holding on to assets can be a plus. And this leads to a question. Many people come in and they go, "Hey, Bill, I'm thinking about giving my son or daughter some stock that I bought 10 years ago, or I'm thinking about transferring ownership of my home over to my son or daughter. Is this a good idea?" The answer is a resounding no. If you transfer an asset, your kids acquire the basis, what you paid for it originally. So I bought my home for 400, it's now worth 900. I transfer it over to my son or daughter. Well, guess what? If they sell it after holding it for a year, all that $500,000 in gain is subject to long-term capital gains. So holding on to assets, smart move. This is something we each need to investigate. Once again, we don't do tax prep. We help our clients figure out tax strategies. Let's talk about property tax. As home values have gone up, guess what? So have property taxes. Ouch. That's a big ouch. In Texas, we pay the sixth highest property tax rate in the country. But there are some opportunities here. And the primary one is when you turn 65, you want to remember to go back to the appraisal district in your county and request a age 65 tax ceiling or tax freeze. I'm 73. Every year I get higher and higher appraisals on my property out in Burnet. And guess what? The property tax rate doesn't go up. The amount they could tax if I was under 65 goes up, but since I'm over 65, my tax ceiling is frozen. What if I decide to move? Well, you can transfer your age 65 tax ceiling to another property. If you go down to your taxing appraisal district and say, "Hey, I'm moving from Burnet to Williamson County," I can get a letter. They will freeze the current valuation on my current property, and I get to transfer that. That's pretty sweet. I buy another property, and once again, the taxing authority in the new county doesn't get a chance to whack me. Other options exist. Let's say you have a widow or widower under age 65, and the other owner dies. Well, the underage widower can claim the tax ceiling and maintain continuation on the property tax freeze. Another option we have, if you're over 65, you can do what is called tax deferment. What is that? Well, let's say I'm heading into retirement, I'm over 65, and geez, my income, my assets are pretty limited, and yet I want to maintain a pretty nice lifestyle. And the property tax has grown into a big pain. Well, I can go down and say, taxing authority, I don't want to pay my tax anymore. I can start deferring my tax. Now, you still owe it, and it will grow at interest. But sometimes taking that tax off the table can free up thousands of dollars that you get to spend on your quality of life in retirement. That can be pretty sweet. This doesn't fit for everybody, but it might be a fit for some of you. Anyway, if you have questions, give us a holler on this. Something else to check out. There's a variety of other tax credits like solar panels. Different counties offer different benefits on solar panels for veterans. These are things you want to check out. You may be eligible for other ways to either reduce or defer or reduce the increase in the cost of your property taxes. So check it out. The last opportunity, we're almost done, and there's no quiz, so don't worry about this. The last opportunity is for some of our higher net worth clients. Some of our higher net worth clients have an interest in philanthropic categories or missions, helping a church or helping an organization help others. And Tara and I help our higher net worth clients investigate some very creative ways to donate and take highly appreciated assets and create tax credits. Let's say I've got some stock that I bought that is highly appreciated. If I were to sell it now, I'm going to pay long-term capital gains. But maybe instead I donate it. Well, what happens? I can get up to a 60% tax credit on the funds that I'm transferring. So that's a savings right off the bat. I can use that tax credit to maybe convert other IRA dollars I have, which are taxable, into tax-free Roth dollars. Boy, that's really sweet. Oh, and that tax donation can be used to create a second tax-free income source. So it's kind of eat your cake and or get your cake and eat it too. You get a tax credit up front, and in addition, that amount that you're donating is creating tax-free source of income to you. There's different ways to do charitable contributions. Tara and I have analyzed a number of them. Some of them look good on the surface, but don't pan out over the long haul. We help our clients make smart decisions. And this also is a way to pass tax-free assets to your heirs. So we've covered a whole lot of opportunities today. And we have others. It's just we could write a book on this alone. In my book, I have a chapter on tax-free, on paying less tax. Tara's going to send you a PDF of the book, but some people prefer a printed copy of the book. If you're one of those, send me an email. My email is real simple, bill@srctexas.com, or if you want to send it to Tara@srctexas.com, and we will mail you free printed copy of the book. I didn't write the book to make money. It's available up on Amazon. If you want to buy a copy, you can pay $9.95. But we wrote the book to educate, and it covers a myriad of topics that most of us are going to encounter in retirement. So, well, Tara, we covered a lot of ground today.
Yeah, we did.
Do we have any questions?
I didn't see any coming up just yet. If anybody has a question, you go ahead and type it into the chat box. Is there anything that popped up in your head when you were speaking?
Geez, Tara, I think we covered
I think we covered so much that
kind of a fire hose today.
Yeah.
But I think what this exposes, there's a lot of ways we're being taxed. And with creative planning, with a little bit of planning, you may be able to reduce your exposure, keep more money in your pocket, pass more money on to your kids. That's the goal. That's the bottom line.
Yeah. So, if you do have any questions, you're always welcome to email us or give us a call, and we're happy to help. And then after this call, I'll send you a follow-up email that'll have a link to the recording. So if you want to listen to it again slowly, you're welcome to, and pass it on to friends and family. And as always, I'll send you the link to next week's upcoming webinar, so you have a chance to go ahead and log on to that. And as well as, like Bill was saying, I'll send a PDF version of our book with the email, but you can always email us your physical address and we'll send you a hard copy. So with that.
And that applies to your kids or neighbors or friends too.
That's right.
If you have a neighbor or friend that's wrestling with retirement issues, the book is about a 1-hour read, but you spend an hour with it, you will know a whole lot about a lot of different topics. And if you've got a friend or neighbor that's wrestling with retirement issues, we're happy to mail them a copy as well. So next week, we're going to be talking about important legal documents, and we're going to have a guest speaker. One of the top elder law attorneys in the state of Texas is going to join us to explain basic legal documents that all of us should have to protect our wishes as we get older. So,
all right, that's it. Have a great week, and we'll see you next week. Bye-bye.